Good morning, everyone. I am Kalpana Kuti from PG and Research Department of Commerce, Arulmigu Palaniyandavu Arts College for Women, Palani. A warm welcome to this session. In this session, we are going to see the answers for the two questions. The first question is, what is meant by accounting ratios? And the second question is, what are the different types of accounting ratios? Let's see the answer for the first question. What is meant by accounting ratio? Accounting ratio, also known as the financial ratio. Accounting ratio is the comparison of two or more financial data which are used to evaluate a business condition. It is an effective business tool that is used by shareholders, creditors, and all kinds of stakeholders to understand the profitability, strength, and financial status of a business. Accounting ratios are also widely used to examine the business performance, and accordingly, business decisions can be made. Then the second question is, what are the different types of accounting ratios? We classified accounting ratios based on the traditional classification and functional classification. On the basis of traditional classification, ratios are classified as statement of profit and loss ratio, balance sheet ratio, and composite ratio. On the basis of functional ratios are classified as liquidity ratio, solvency ratio, activity or turnover ratio, and profitability ratio. First of all, we are going to see on the basis of traditional classification. The first ratio is statement of profit and loss ratio. A ratio of two variables from the profit and loss statement is termed as statement of profit and loss ratio. For example, the ratio of gross profit to revenue generated from the business operations is referred to as gross profit ratio. It is calculated by using both the figures derived from the profit and loss statement, which is profit and sales. Then the second one is balance sheet ratio. If both the variables of the ratio are from the balance sheet, then it is classified as the balance sheet ratio. For example, the ratio of current assets to current liabilities is termed as the current ratio. It is calculated using both figures derived from the balance sheet. And the last one from this is composite ratio. If the ratio are calculated using one variable from financial statement and another variable from the balance sheet, then it is termed as composite ratio. For example, the ratio of credit revenue from business operations to trade receivables is termed as the trade receivable turnover ratio. It is calculated using one variable from the profit and loss statement, which is credit revenue from business operations, and the another variable from the balance sheet, which is trade receivables. Then, on the basis of functional classification, first one is liquidity ratio. To meet business commitments, the business needs liquid funds. The ability of business to pay the due amount to stakeholders as when it is due is known as liquidity. The ratio calculated to measure it are known as liquidity ratio. The liquidity ratio are short-term in nature. They are calculated to measure the short-term solvency of the business, that is, the firm's ability to meet its current obligations. The liquidity ratios are current ratio and quick or liquid ratio. The second one is solvency ratio. The business solvency is determined by its ability to meet its contractual obligations towards stakeholders, specifically towards external stakeholders, and the ratio calculated to measure the business solvency positions are known as the solvency ratio. The solvency ratios are long term in nature, and the solvency ratios types are debt equity ratio, debt to capital employed ratio, proprietary ratio, total assets to debt ratio, and interest coverage ratio. And the third one is activity or turnover ratio. These are the ratios that are calculated for measuring the efficiency of business operations based on the effective utilization of resources. Hence, these are also termed as efficiency ratios. The higher turnover ratio means better utilization of assets and signifies improved business efficiency and profitability. The most important types of activity ratios are activity turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, net asset or capital employed turnover ratio, fixed asset turnover ratio, and working capital turnover ratio. The last one is profitability ratio. Profitability ratio or referred to as analysis of business profits in relation to the revenue generated from the business operations or assets used in the business, and the ratio calculated to meet its objectives are termed as profitability ratios. Under the profitability ratios, there are some ratios, that is gross profit ratio, operating profit ratio, net profit ratio, return on investment or return on capital employed, return on net worth, earning per share, book value per share, dividend payout ratio, price earning ratio. From this session, you all get a good idea of accounting ratios and the different types of ratios. Thank you everyone.